Hello and welcome to Big Deal. I'm Nisha Poddar. Now, Ghar Wapsi theme is gaining momentum in the startup space in the midst of several headwinds faced by the new age digital companies. Now, Ghar Wapsi is essentially domiciling back to India those startups which are founded by the Indians operating in Indian market presently but incorporated overseas. And this can be done through a process of reverse flipping. But this is not an easy structure, nor is it tax efficient, and the startups seek government support along with also tax dispensations. Gift City has stepped in as a possible solution, and the IFSCA committee has made recommendations to the government on simple reverse flipping to Gift City as an option. Let's delve deep into this particular topic and how the industry players see it. Siddarth Pai of 314 Capital, Mitul Mehta of Blume Ventures, and Ajay Rootti from Tax Compass. All of them join us for this discussion. Thank you, gentlemen. Always welcome to CNBC-TV18. Now, Siddarth, you're a member of that IFSCA committee. Let's begin with what are those measures that have been suggested to the government for the reverse flipping to happen in the Gift City?
So thank you very much, Tesha. One of the things we actually spoke about at the committee quite often is what is the kind of changes we need to see from an Indian regulation perspective in order to attract these companies back. I think PhonePe actually set the ball rolling by actually paying close to $1 billion in terms of tax, but I don't believe many of the startups end up having that sort of fiscal space on their balance sheet to end up making that sort of contribution as of now. So one of the things we actually based the entire archetype is from a tax perspective. The government of India in 2021 created a scheme for foreign funds who invest into India to re-domicile to Gift in a tax-free fashion. So we've actually taken a leaf out of that playbook and created a similar kind of framework for Indian companies or holding companies overseas to end up actually re-domiciling back to India without paying any capital gains tax, income from other sources, or any other associated taxes that actually ends up coming with that entire piece. So that's actually one part to end up actually getting that entire thing through. The second thing that we've actually seen over there that we need to end up doing is to make sure that the kind of incentives and the kind of operating leeway that was given to these companies overseas is similarly replicated in Gift IFSC as of now. So to make sure that some of the frameworks regarding corporate law, frameworks regarding giving of ESOPs, not just to employees, but to vendors, to consultants, and to professionals as well for that matter, creating a separate framework when it comes to corporate litigation, and to make sure there's a separate litigation practice and a separate system, separate judicial system that ends up applying over there becomes important. The third part that becomes important as well is, since Gift IFSC is relatively new, what are the kind of measures that the city needs to end up actually undertaking to make sure that quality of life can end up attracting people not just from India but from overseas as well into Gift itself. The next, when it came to capital raising, also to make sure that the process of capital raising in Gift is something that's more attuned to what you see overseas. So creation of SPACs when it comes to Gift IFSC, making sure that they actually have access to hybrid instruments also for that matter, that can end up actually converting into various forms and are more attuned to what investors expect when they invest into a Singapore or a Delaware or something for that particular matter. And the last set actually becomes the operating changes to Indian regulations to make sure that all this can actually end up going through. So we've already based it into 5 buckets as of now, because the purpose of the committee was to make sure that the report is comprehensive. Because in these sort of large-scale situations, if one of the bodies of law, one of the acts are not actually amended, it may end up undoing the entire thing. So we spent a substantial amount of time to go through the entire transaction chain, identify these areas, end up actually giving suggestions along those lines itself. So,
Siddarth, what has been the government's response to it, to these recommendations?
So, Disha, the report has been very, very warmly received by the government as of now. Based on discussions we've had with the secretaries, with various people as well, they were very happy to see the report and the kind of sessions that have actually come about, because it has set a framework now that the government needs to end up actually exploring to make sure that they can decide what are the elements they can incorporate as of now, what can you do in the medium term, what can you do in the long term, etc. So one of the things that the government has been very outspoken about is the fact that we need Indian startups to actually come back to India. India should be a land of startups, not of subsidiaries. And this particular report will ensure that the majority of India's unicorns who are overseas have a particular glide path to come back to India. And the next set of companies who are also unicorns or companies or entrepreneurs looking to incorporate their company will end up choosing India as opposed to choosing a foreign jurisdiction when the bulk of the market remains in India itself.
All right, so that's a great attempt by the IFSCA and warm response from the government as well. That's what Siddarth Pai has shared. But I want to understand from the VC community perspective, because a lot of things that the startups and the unicorns do are really guided by the investor community who are so heavily invested in them. So Mitul, what do you make of this IFSCA flipping as an option?
Sure. So I think it's definitely good steps. I think the report is very well put out and thought through. From our perspective, as VCs, I would categorize investors in two buckets. One is the SEBI-registered funds, and others is non-resident investors. So typically, for SEBI-registered funds, we have to go through a certain process for investing outside India. Now, in case of companies that are domiciled in GIFT, for us, the report, of course, has recommended an exemption, but for us as VCs today, we have a certain cap on the fund size beyond which we can't invest in companies domiciled outside India. So for us, I think till we don't have that the neutrality or the exception, we are probably indifferent. But for the global ecosystem, yes, it opens up an eventuality for investment in GIFT IFSC for sure. I see it taking some time. I don't think there will be immediate movement because the ecosystem is yet to develop. So maybe it will start with fintech companies, edtech companies. These are the sectors that IFSC is focusing on. But with that, what is also important is the ecosystem. So a lot of these companies coming back are primarily coming back to list on Indian exchanges. Now, at GIFT IFSC, the exchange is still at a nascent stage. And of course, as it grows, that becomes a viable option as well. So we would think of it that way. I think right steps in the good direction, but I think it will take some time to kind of eventualize it.
All right. So wait and watch and see how that really evolves. Ajay, Rootti, what do you think of the IFSCA measures that have been presented? And what do you think is the core of this issue in reverse flipping when it comes to tax efficiency? Where does that particular matter lie?
Nisha, I think one of the most important considerations is really the tax consideration. And like Siddarth mentioned, if you see the tax bill that phone pay to foot, then you know what's the quantum of taxes that are involved. There are 3-4 aspects when it comes to tax. One is really the one-time exit tax or the tax that you incur to flip your structure, which essentially means, there's a, overseas holding company in which there are shareholders. They give up those shares and get shares in an Indian company. Therefore, there's a transfer. You can do it as a part of a cross-border merger. In some cases, that will be tax neutral, not in all cases. That's one large bucket, which is really the tax in the hands of the shareholder at the time of the reverse flipping. Second is really the Indian companies in a lot of these cases would have losses. And there is a provision in the Income Tax Act which prohibits carry forward of losses if there's a change in shareholding beyond 51%, very simply put. So that's another piece where there will be a leakage. And the third is the transfer pricing and other aspects, FEMA, ODI. These are really the big key tax considerations. Now, what does the IFSCA report do? I personally think it's a brilliant report in terms of identifying all issues that could possibly come up. And there is a solution, there is a proposal as to how some of these could be negated in all cases. So they have suggested tax neutral flipping, a one-time exemption for the flip that happens, exemption from this carry forward loss that you would lose, therefore permit the carry forward losses to be eligible for carrying it forward and set off later if you flip into IFSCA. I think the IFSC regulations, the changes that are proposed are very good. But what needs to be done is, in addition to these tax changes, there are also certain other regulatory changes which are again being highlighted in the report, whether it's the ODI thing, whether it's for listing. These also have to be done together. If all of those are not done, then it doesn't become a viable option. We can't do this in parts. There can't be half measures. We can't have only a tax neutral flip, but not address other aspects relating to overseas direct investments or listing regulations and things like that, or ESOP for employees, for example, or investment by residents into those companies.
That's
so it has
right.
to be seen as a whole, and the report has to be considered in toto, in my view.
All right, so a lot of overhaul is really needed for tax efficiency as well as also to give it the benefits of being re-domiciled. So we'll discuss a few of those technicalities when we are back after a very short break. But remember that a lot of startups want to come back with an IPO mandate. We'll focus on that particular aspect as well when we return. Stay tuned to Big Deal.